How's it going, everyone? My name is Dan, but you can call me Malone. And if you checked out last week's video, you'll know that we discussed everything to do with stock market indexes, index funds, exchange traded funds, and mutual funds. It was a value-packed video, and I highly recommend going ahead and checking it out if you haven't already. So this week, following on from the theoretical discussion we had last week around stock market indexes and the fund structures which track these indexes, what I thought we could do today is to dig into the S&P 500 index and show you guys how exactly it's made up. Similar to last week's video, the purpose of this exercise is to break down all the unnecessary and confusing jargon associated with investing in funds, particularly those which track an index, and to show you guys that it really isn't as complicated or daunting as it might seem. So if that all sounds good to you, before we begin, can I ask that you please leave a like on the video? By liking the video, you're playing your part in spreading the word about the importance of financial education, so thanks in advance for doing that. And if you are new around here, please do consider hitting that red subscribe button below and joining our community of financial enthusiasts. We make financial education videos on this channel aimed at making conversations like these more of a cultural norm. So without further ado, let's get started. So what exactly is the S&P 500? The S&P 500 is the abbreviated name for the Standard & Poor's 500 index, and Standard & Poor's themselves are an American credit rating and financial research agency. You might better recognize them from that scene in The Big Short where Steve Carell is grilling the blind old lady over Standard & Poor's credit ratings. Anyway, what I have on screen in front of me is the fact sheet for the S&P 500 index, and this can be found on the S&P Global website, and I'll leave a link to that in the description if you're interested in checking it out. These fact sheets will tell you everything you need to know about the index you're looking at, and you can find the fact sheets from most major indexes online. So as we can see from the description section of this report, the index includes 500 leading companies, and that's actually 505 to be exact, and covers approximately 80% of available market capitalization. So what exactly does this mean in English? First thing to remember is that an index is defined as a sign or measure of something, and therefore a stock market index can be said to be a measure of a part of the stock market. So the S&P 500 index is a measure of the top 505 companies in the United States. Now we can see here that the report tells us that the index covers approximately 80% of available market capitalization, aka market cap. Market cap is effectively just the total value of a given company as determined by the stock market, and is calculated for the purposes of the index by taking the number of floating shares and multiplying it by the share price. So for example, if a company has a total of 10 million floating shares out there being bought and sold by investors in the market, and it has a current share price of $100 per share, well then the market cap of that company is $1 billion, i.e. 10 million shares multiplied by a $100 share price. So when this report tells us that the S&P 500 index covers 80% of the available market capitalization, what this really means is that the index covers 80% of the total value of the US stock market. Another way to think of this is that the index covers 80% of the total value of all the companies operating in the United States. So it's fair to say that by and large, the S&P 500 index is representative of the US stock market as a whole, because again, it's covering 80% of the total market value of US companies. So if we take a look at the methodology construction section of the report, we can actually see the various criteria that companies must meet in order to be considered for inclusion within the S&P 500 index. The first requirement here is that all constituents must be US companies, so we're not going to see any international companies included within the S&P 500 index. The next requirement here concerns market capitalization, and we can see that in order to be considered for inclusion within the index, companies must have an unadjusted market cap of $9.8 billion or greater, and must have a float adjusted market cap that is at least 50% of the unadjusted minimum market cap threshold. So again, what does this mean in English? All this means is that companies who are looking to be included within the S&P 500 index must have a market capitalization associated with freely traded shares of around $4.9 billion. The next requirement has to do with public float and states that companies must have an investable weight factor, or IWF, of at least 0.10. Again, this has to do with the number of shares which are freely traded on the market between investors. Financial viability. companies must have positive as reported earnings over the most recent quarter, as well as over the most recent 4 quarters summed together. So in order for a company to be included within the S&P 500 index, its most recent 3-month financial results must have been positive, and its most recent 1-year financial results must have been positive in aggregate. The reason for this requirement is likely to exclude any highly valued but also highly loss-making companies from the index. This next requirement I think is the most interesting one: adequate liquidity and reasonable price. The ratio of annual dollar value traded to float adjusted market cap should be at least 1, and the stock should trade a minimum of 250,000 shares in each of the 6 months leading up to the evaluation date. Effectively, this is to prevent illiquid shares from being included within the index. If your shares are liquid, what this means is that they can be converted to cash easily, i.e. you could log on to your brokerage account tomorrow and sell the shares at a fair market price, no questions asked. But if the shares are liquid, it might be difficult to find buyers and sellers, but more importantly, the actual fair market value price of the shares themselves might be skewed due to the lack of market participants. So when the report states that the stock should trade a minimum of 250,000 shares in each of the 6 months leading up to the evaluation date, what this is really doing is providing some level of certainty and comfort over the liquidity of the shares. These last 2 points in the methodology construction section of the report really just have to do with how different sectors are represented within the index and the types of companies which are eligible for inclusion. So moving on to the quick facts section of the report, we can see that the weighting method for the S&P 500 index is based on the market capitalization associated with floating shares. And if we actually scroll down, we can see that the report has provided us with the top 10 constituents by index weight included within the index. This is effectively the top 10 companies which are included within the S&P 500 index, and they're ranked in accordance with their individual market caps relative to the total market cap of the S&P 500 index as a whole. So we can see that Apple has the highest weighting in the index, followed by Microsoft, Amazon, Facebook, Alphabet, which is Google, Tesla, Berkshire Hathaway, JP Morgan, and Johnson & Johnson. Now, the interesting thing to note is that this report is actually dated as of February 26, 2021. And if we were to compare this list above to the actual updated rankings, we can see that the rankings have changed slightly. So if we take a look here at the Slick Charts website, which is effectively updated every day for the newest rankings in the S&P 500 index based on the current market capitalization of the companies, we can see that the rankings have actually changed as compared to the report which we were previously looking at. The biggest notable change is that both Berkshire Hathaway and JP Morgan are now ahead of Tesla, whereas if we go to our report, we can see that Tesla is ahead of both Berkshire and JP Morgan. And effectively, this is due to the poor performance of Tesla stock over the last couple of weeks. And this is a great example because it just goes to show you how market sentiment can influence the weightings within the index itself. Because remember, a key component of the market capitalization calculation is the share price. So if the share price goes down, the market capitalization is going to go down, and therefore the ranking associated with the company in the index is going to fall. And you can actually see the exact weighting of the stocks themselves within the index in this weighting column here on the website. So we can see that at present, Apple has a 5.76% weighting, Microsoft has a 5.32% weighting, Amazon has a 3.9% weighting, Facebook has a 1.9% weighting, and so on and so forth. And as the market value of these stocks continues to change each and every day, so too will these weighting figures. Another way to think about this is that if you were to take €100 today and invest it in an ETF which tracked the S&P 500 index, €5.76 of your investment will go towards Apple, €5.32 of your investment will go towards Microsoft, €3.90 will go towards Amazon, etc, etc. It's also interesting to look at the sector breakdown pie chart, and unsurprisingly, we can see that information technology companies account for 27.4% of the index. So effectively, those are your companies operating in the tech space. But this breakdown really does show you that there is a vast number of industries included within the index, such as healthcare, consumer discretionary, financials, communication services, industrials, consumer staples, energy, materials, utilities, and real estate. But the point to take away is that different sectors are weighted more heavily than others, depending on the market cap of the companies included within those sectors. Again, if we were to think of this in the context of our ETF analogy, where we invest €100 in the ETF which tracks the S&P 500 index, 27 €7.40 of our investment will go to companies operating in the IT space, €13.10 will go towards healthcare, etc, etc. So we can see here that per the report, the total market capitalization of the S&P 500 index is nearly $34 trillion, an absolutely astronomical figure. If we take a quick look at the historical performance of the index, we can see that the annualized returns for the last 10 years has been 13.43%. Now, when we compare this to the types of returns that you can expect by leaving your cash on deposit in a bank account, this is in a completely different ballpark. But if we actually look at the calendar year performance of the index, which is effectively just the performance of the index each and every year, we can see that it's not exactly smooth sailing. 2019 saw 31% returns, 2018 saw minus 4% returns, 2016 saw 11%, 2014 13%, 2011 2%, 2012 16%. You can see that there's a massive variance in the types of returns that can be expected each year. And I suppose what you need to take from this is that in order to invest successfully in an investment product which tracks the S&P 500 index, what's required is a long-term mindset. Your returns are going to vary year over year, but really that shouldn't bother you, because if your investment horizon is 30, 40, or even 50 years, ultimately all you care about is your annualized return at the end of the investment horizon, which for a lot of us will be when we retire. The report also provides some information around the fundamentals of the index, such as dividend yield and other various multiples. The last point to note is that in this end section of the report, you'll actually find a full list of the different types of ETFs or exchange traded funds which track the S&P 500 index and the stock exchanges where they're listed. And this can be really useful when you're trying to find an ETF that you can invest into based on where you're living currently in the world. So that about wraps up the S&P 500 index. It's always interesting to do a bit of digging and analysis on these indexes, so I'll probably make a similar video on the Nasdaq and the Dow Jones in the coming weeks. So I really do hope you enjoyed the video here today. As always, if you did enjoy the video, please do let me know in the comment section below. Leave a like on the video, subscribe to the channel, and I'll see you in the next one. Cheers.